Few would disagree that an efficient and effective intergenerational wealth transfer and estate planning strategy should incorporate lifetime planning and planning through the will on death. It's really important to take account of all of your assets in a truly holistic sense when you're planning for intergenerational wealth transfer. So what do I mean by that? Taking account of your cash, taking account of your property, taking account of your investments, taking account of your pensions, and if it's relevant, taking account of your business. So before considering just what planning you can carry out with those asset types I've just mentioned, it's important to remember that when it comes to inheritance tax planning during lifetime, there are gateways and hurdles to consider. First, the gateways. Most obvious gateways are the exemptions that you have available to you, especially the annual exemption and the normal expenditure out of income exemption. That exemption which says, provided you make your gifts regularly, provided you make them out of income, and most important, provided they don't affect your standard of living detrimentally, it's okay. They're free of inheritance tax without limit. And what else is there? There's of course the nil rate band standing right now at £325,000. You can make gifts over and above the exemptions up to that amount completely free of inheritance tax, and the clock's effectively zeroed every 7 years. So let's have a look at the hurdles the government have put in place to make planning a little more difficult. They stem from the natural desire among many people to not want to give away if they lose all access to the assets, and to some extent if they lose control over the assets. The control point you can usually get over legitimately and efficiently with a trust, but the access point a little more difficult, because you might want to have access to the income from something that you've given away, or in the future you might go, actually I might need that back, so I won't give it away. And that's really great from the HMRC's Inland Revenue standpoint, because if they can stop you giving assets away efficiently, then you'll have more in your estate on death, and there'll be more inheritance tax to pay. So what have they done about that? What they've done is to introduce, many years back actually, the gift with reservation provisions, reinforced by the pre-owned assets tax provisions. Basically, they say that if you give something away but can continue to enjoy the income from it, or the use of it, or have access to it even in the future, possibly even, that will mean that it's not outside of your estate for inheritance tax. So that's something to bear carefully in mind. So let's have a look now at the asset types I mentioned at the beginning of this programme. Cash. Cash is the best asset of all to plan with. You don't have a CGT consequence that you might have to think about with other gifts of other assets that are subject to capital gains tax. You don't have to think about that at all. If you can make a straightforward, outright gift of cash, that's really easy, and after 7 years you can forget it completely from an inheritance tax standpoint. And if you want to retain some access to the asset that you're giving, or the control to the asset that you're giving, which is cash, which might turn into something else once you've given it, then that's also easy. The control point, as I mentioned earlier, can be done, can be overcome, can be given with a trust. The access point can also be used with a trust, possibly with an insurance product combination together with a trust to help you to overcome your need for access. If you just need access to income, effectively regular payments, a discounted gift trust would help you. Tried, tested, it works. And if you die within 7 years of making the gift, of course, the amount that you've given is much less than for inheritance tax at least, than the amount you've actually given. But a loan trust can work really well, where you might also require, as well as regular payments or even irregular payments, access to the capital, the original capital that you've given. Meanwhile, the asset that you have given can grow in value, and all that growth is outside of your estate. So with a loan trust, you simply set up a trust by declaring it, then you make a loan of money, importantly, interest-free and repayable on demand, so that makes it not a gift. The money is then invested by the trustees. The growth is outside of your estate, but at any point, you can ask for your money back, your original money back, because you're a creditor. You're not benefiting out of the trust. You're not getting caught by the reservation of benefit provisions. You can ask for your money back. As a creditor, you can have that regularly to give you a kind of income, or you can just leave it, and if you did need it, it gives you that reassurance that you can have your money back if you need it. And if in the future you go, actually, you know what, I don't need this reassurance anymore, then you can write off the loan. That'll be a gift, of course, which you'll need to take account of, but you can write it off. So the loan trust, really, really efficient. And lastly, I can't not mention, if you really want complete control and complete access, and actually not to make a gift at all, but still be inheritance tax efficient, you could invest in an asset that qualifies for business relief. It has other things you need to consider, liquidity, a higher element of risk perhaps, but a business relief qualifying asset well worth considering. So let's turn now to property, one of the main asset classes, especially your main home, your principal private residence. What can you do with that? Well, not very much because of those hurdles. The revenue know it's an important asset class, so they've made it hard for you to give it away. So it's really hard to give it away and carry on living in it, basically. There are two exceptions. You can give your house away, carry on living in it, and pay a full market rent to the persons, probably your kids, that you've given your house away to. So that can work to get some money out of your estate actually without it even being a gift because it's rent. The other way is to actually give a part of your house away to the person that you want to benefit from it, but that person comes and lives with you, or that person or persons comes and lives with you, so joint occupation. So there are two ways, exceptions that don't serve that many people, so the government largely do their job with the reservation of benefit rules and pre-owned asset tax rules. Of course, if you've got a second property or another home that you use periodically, it's a little easier to give it away and just go back and use it now and again and pay for the use. Before leaving planning with residential property, it's worth a mention at least to lifetime mortgages. If you want to make a gift, give someone the benefit of that gift during your lifetime and obviously their lifetime, then having a lifetime mortgage on the property would allow you to release money from that property, create a debt on the property, beneficial from an inheritance tax standpoint, while the property remains subject to inheritance tax. Taking the money and making a potentially exempt transfer of it drops out of your account after 7 years in effect. It's absolutely not right for everybody. You absolutely need to do the detail for every particular case, but something worth thinking about. Investments next. Can they be given? Yeah, of course they can. Should they be? Well, like all gifts, it depends. Can you use a trust? Absolutely. Many trusts invest in many investment types. Is CGT relevant when you make a gift? Yeah, it could be. Most investments, insurance products, bonds are the exception, pretty much. Most investments are capital gains tax chargeable assets. So when you make the gift, this is quite an odd point this, but when you make a gift, you get no money by definition, you get no return for it. But by making the gift, it's treated as if you've sold that asset for its market value. So when you're thinking about making a gift of investments, subject to the exception that I mentioned, you need to think about carefully this capital gains tax relevance of that, whether CGT is relevant, because you're going to save inheritance tax, but you could trigger a capital gains tax liability. So that's something to bear very, very carefully in mind. So if you're a business owner, how about your business? Should you be worried about inheritance tax planning in relation to your business? Can you plan in relation to your business? First point is, most people would think, I don't need to be worried about inheritance tax because my business qualifies for business relief. And in most cases, it will. The conditions are relatively well known. However, you need to think quite carefully about what the position would be for your family, because this is about intergenerational planning. For your family, if the business is sold, or if you sold the business, your exit plan is fulfilled. If that is your exit plan, you sold the business, you've got the money. Then clearly the money you have then is subject to inheritance tax. Some planning ahead of making the sale might be worth thinking about. How about a sale taking place after death? That might happen for more people. If you've done your work right between you and your business partners, you'll have something in place that says what will happen when each of you die. What will happen to the shares, which will be an expression, an articulation of really what you want to happen, putting in place the means to make what you want to happen actually happen. And what that would typically be is that you would take out an insurance policy on your life. You would leave your shares to your family in your will, probably your spouse or partner, but maybe your children, for a bit more inheritance tax planning. The insurance policy will be in trust for your co-owners. So on your death, the insurance policy pays out free of inheritance tax to your co-owners. They've got the money. The shares pass to your personal representatives to hold for whoever you say should have them, your family. Then there's an agreement that you've entered into that says you guys with the money have to swap that money for the shares that the personal representatives are holding for your family. So the end game in all this is the family get the money and your co-owners get the shares and carry on running the business. Your family is no longer dependent on the business, but has the money. And here's the thing, the money is not then free of inheritance tax, because unless they invest in another business, that money is not subject to business relief. So that's another reason to think ahead about planning, even if you think, I don't really need to, because my main asset is my business asset. You need to think ahead and look at what the position will be for your family if a sale takes place. You can be helped in that, of course, by great financial advice. So let's consider pensions. The great thing about pensions is they are inheritance tax free, so we don't need to worry about them, do you? Well, it's a little bit like the business really. It's great while the assets are in the pension fund, but once they've left the pension fund, say following your death, then there is an inheritance tax issue to consider for the family, for the people that receive the money. We know that it's IHT free when it leaves the pension fund. There is an income tax charge if it leaves after the person whose fund it was has died after age 75, but IHT free. It's when it comes out that it becomes subject to inheritance tax because it's left the protective zone of the pension fund. So some planning ahead with appropriate trust might be worth thinking about. So we've considered all of your assets, all of the main asset types. We've considered cash, we've considered property, we've considered investments, we've considered business, and we've considered your pension. So when you're thinking about lifetime planning, the key determinants of just what you can do and how you can do it are these. Number one, the assets you own. Number two, how much control you want over those assets once you give them away. Number three, really importantly, how much access to those assets you want once you've given them away. If you can get all of that right, your IHT planning during lifetime is well set. Now, of course, you need to consider what you can do in relation to planning with your will. And any liability that is left, don't forget about good old life insurance. A simple way of providing for the IHT liability without any risk of HMRC, Inland Revenue attack. Quite simply, you make the premium payments, which are almost certainly going to be exempt, into the policy. That's the point of the gift. The policy is held in trust, so it's outside of your estate. And when death occurs, after death, when the payment is made out to the beneficiaries to help them meet the inheritance tax liability, it's completely free of inheritance tax. Couldn't be simpler. Before leaving, I have to mention that, of course, the Office of Tax Simplification reviewed inheritance tax a little while back. The government still haven't got round to looking at those reviews. Who can rule out what might happen in the future? And that's why you need to keep tuned in to Techlink to find out. For many people, it will be a combination of strategies that work together to give the optimum outcome. Some lifetime giving, obviously some planning with the will, and maybe some life insurance in trust to provide for the remaining liability. Whatever combination you use, the one thing that's absolutely critical is your advice.